This is the topic that I'm going to address is something that's really important, and it's one that can create a lot of confusion. I'm going to show you some charts that indicate if you have to choose the right time frame to decide what is doing well in the markets, whether it's the stock market or the commodity markets. And there's been a lot of deception and bias on the part of gold bugs in particular, arguing that gold is a best performing asset compared to other classes. So as soon as this gets set up, let me just first say that today was a very difficult time in the market. It's a return of the deflationary the stagflation that's occurring. The sharp rise in inflation is causing a second round of selling. A lot of people thought that the selling had finished, but it apparently has not. So we're in a full-scale bear market, and it even affected the commodity sector as well. My Freeport-McMoran stock that I recommend was down 3% today. The gold stocks were down today. There was there was no place to hide except for the dollar. We've been recommending UUP is the symbol, is the dollar index. That was up today and is up about 10% so far this year. So we're in the dollar fund. In our trading services, we're also shorting the market, not only the stock market, but a lot of other sectors in the economy. So we're going through a full-scale retrenchment, and it's very difficult to predict when these things are going to end. So I'm going to show you the first one. This is gold versus the S&P 500. Now, this is a chart that Goldbug sent me, somebody who sells gold and silver. So you can see why they would show this chart. Gold has outperformed the stock market in terms of total return since the year 2000. Rather dramatically, right? The gold price has moved up substantially compared to the S&P 500. But the reason why this chart is deceptive and actually inaccurate is the time he chose to start this index, the two indexes. He started in the year 2000. Well, in the year 2000, the S&P 500 was at an all-time high, had risen hyperbolically, and began a 3-year bear market. So he started the year 2000 when the stock market was at an all-time high, and what was gold at? $250 an ounce. So he also chose a time period when gold was deeply undervalued while stocks were deeply overvalued. So as a result, you get this, even though clearly gold is much more volatile, as you can see from this chart, it outperformed since the year 2000. However, let's see, this is total return as well, in which case, remember, gold does not pay any dividend or interest, but the S&P 500 does. So now, if you look at the year 2000, the difference is narrowed because the S&P pays a nice, stable, rising dividend. Okay, but even then, gold has still slightly outperformed the S&P 500 since the year 2000. However, if you go back since 2011, just the opposite occurs. Now, what is happening in the year 2011? Well, now I've chosen when gold reached a top in 2011, late 2011, while the S&P 500 was in a major bull market, a mother of all bull markets. And in that case, you can see since 2011, you come to the very opposite conclusion. So my point is, be very careful when you look at charts. Statistics lie, charts lie. You have to look at the total picture. There are times when gold outperforms stock. There are times when stock outperforms gold. But I will tell you, this is a better chart since 1990, and since 1990, what a difference. Now you have both periods of bull and bear markets, and you can see a rather dramatic difference. S&P 500 is investing in successful businesses. They drop out in the S&P 500, they drop out companies that are underperforming, and they add to it companies that are booming and are being successful. So the S&P 500 represents the best of America in terms of performance of individual businesses. Gold is a sterile commodity. Yes, it's being produced by mines and so on, but you only increase the amount of gold by 1 or 2%. So it is a reflection of the inflationary environment, and we can see for a long period of time, inflation has not been a problem, and the stock market has roared ahead. Let me tell you something. The stock market hates inflation. A lot of people think that inflation is good for the stock market. It is not, especially when you see a dramatic change like you're seeing right now. Lots of studies have shown that the stock market and the bond market do not like inflation. The other thing that you need to know is that gold is a leading indicator. I've done a number of econometric studies that show that gold is a really good leading indicator. So it really increased rather dramatically from 2018 to 2020, topped out in 2020, just as the inflation got started in terms of price inflation. But that's the end result. So it's still, I think gold is still a pretty good indicator of inflation. And of course, it has underperformed recently. So that suggests to me that in the future, inflation is going to come down. The United States is not Venezuela. Canada is not Venezuela, although Canada is heading toward Venezuela. Their inflation policy is much more inflationary than the United States Federal Reserve. They're increasing their money supply rather dramatically here in Canada, and that's why I'm bearish on the Canadian dollar. I think it will drop even further than its current rate of, 75 cents or something like that, okay? So that's a concern for Canada. But clearly, it pays to invest in the markets. I'm a Warren Buffett fan. Warren Buffett, when I met Warren Buffett several years ago, I pulled out my 50 peso gold coin. I showed it to him and I said, "Do you collect these?" And he says, "No, I collect businesses and friends." And he walked away. So much for my friendship with Warren Buffett. Didn't last too long. Anyway, I'm more in the Warren Buffett camp because stocks, because they're successful, growing businesses. The mining business is a very tough business. It's relatively low profitability. Everybody has a great story, right? You haven't heard a bad story here. You haven't had a single mining company executive get up and say, "Hey, we're really struggling. We can't find any minerals. Our costs are going through the roof." Have you heard anybody say that? No, of course not. Everybody tells a good story, so you got to be careful in that regard. So you'll see in the last year, commodities have been outperforming gold. So you're in that unique period that doesn't happen a lot historically, but now you're seeing with commodity prices rising. So commodity investing is probably a better deal than investing in commodity producers and mining companies. And there's a lot of reasons for that. You can see a pretty good upward trend there in commodities versus the stock market, which has been in a downward trend, okay? Now, this is the U.S. bull and bear markets. Now, if you look at this chart, you can see that bull markets last a lot longer than bear markets. This will probably be the same case this year in 2020. I believe we are in a bear market, but it is relatively short. It doesn't really last too long. And the reason is because entrepreneurship is still very much alive and well in the United States, despite every effort by the Biden administration to destroy entrepreneurship, to overtax us, overregulate us. This guy does not have a clue, but the people behind Biden do know what they're doing, and it's a radical agenda. So here's Canada's bull and bear markets. I mean, that's quite a difference, isn't it? This is the U.S. bull and bear markets. This is Canada. I mean, what is that big red? You have bear markets that can last a long time in Canada because the index is dominated by mining companies. So you have your bull markets, but my gosh, you've had a bear market there since when? Well, that's a long time, since 2011. Okay. S&P 500 returns. Now, I saw this chart in a textbook on the stock market, warning people the stock market is extremely volatile. Does that look volatile? Yeah, up and down like a yo-yo, right? Up and down like a yo-yo. These are changes in the S&P 500. But if you look at total return, makes a total different story. Again, charts lie, statistics lie. This is a lie. This is a lie. This is the reality. Okay? So that's really a very bullish chart, for sure. Now, let's take a look at the VRIC Gold Miners ETF versus the S&P 500. So the S&P 500 has outperformed the index, but I want to show this to demonstrate the incredible volatility in mining companies. Extremely volatile. So you can see the VRIC, there's just no comparison to the S&P 500. So individual holdings. I made a point this morning where I said I couldn't find a single major, not just the penny stocks, I couldn't find a single major stock that had a long-term bull market. Can you imagine that? This is a shock to me. So Newmont Mining. Okay, you can see a slight upward trend, perhaps. Newmont Mining, and that's since 1990. Barrick Gold, look at Barrick Gold, has had no trend at all. No trend. Gold has done better than Barrick. Franco-Nevada. I mean, Wheaton. Now, granted, it doesn't include the dividends. So you got to add the dividends and you probably get a little bit of an upward trend. But it's not like compared to the gold. You can see a bare upward trend in Agnico Eagle Mines, AEM, North Star, just Kinross, Goldfields. I wrote a book called Investing in One Lesson. Wall Street exaggerates everything. And the stock market does exaggerate. The red line is the nominal S&P. The green line is the S&P 500. So stocks are inherently volatile in and of itself. But mining stocks have to be the most volatile ever in the history of any indexes. So that's really an important point. These are some of my recommendations right now. Main Street Capital has come through as a great business development company. They invest in, if you want to invest in pre-IPOs, check out Main Street Capital. 99% of their stock selection has been closed, either gone public or been bought out at a profit. 99%. Now that's really good selection. How many of you have the ability to go in this chart or anywhere else and get 99% of your stock picks turning out to be profitable? That's how good these people are, based in Houston. Enterprise Products is my favorite oil company, pipeline company. You can see it's been quite volatile, but it yields 7 to 10% rising dividend. So I like Enterprise Products a lot. And my flying 5 stocks, Coca-Cola, Walgreens has not done well, as you can see. These are the 5 Dow stocks with the highest dividend and the lowest price. Cisco Systems has done well. The Dow has done really well. The chemical Dow company is up 10% this year. And Verizon has not done as well as the Dow Jones, but it looks deeply undervalued at this point. So my main message is an optimistic one. Stocks have outperformed all other assets. They've outperformed bonds. They've outperformed cash. They've outperformed gold. They've really done well, and the U.S. market in particular has outperformed all other country funds, including Canada, including European markets. Latin American markets are not even in the survey because they close a lot of times. So that's the case. And even since the year 2000, the U.S. has way outperformed other sectors in the economy. Now, this is a testing period, whether that trend will continue. I'm very hopeful that in November, the Republicans will take back the Capitol Hill, which they shouldn't have lost in the first place because Trump was such an idiot. He didn't know what a good thing he had. He could not act presidential. And if he had acted presidential just during the debates, he would have won by a landslide, even without any cheating. Forget the cheating, okay? He just was a bad mistake. So we're going to get 2 years of gridlock, which is better than nothing. So the market should do pretty well because you still have the Trump tax cuts in place, and hopefully a deregulatory environment, and hopefully the pandemic is away and people live normal lives. So I'm relatively optimistic. So this is a picture of me with Warren Buffett. I mentioned Warren Buffett before. You can see here, I'm giving advice to Warren Buffett, the greatest investor in the world. Also, I have a book called A Viennese Waltz. If you go to skousenbooks.com, you can find out more. All the information is in the newsletter. I did want to tell you just briefly about my conference called Freedom Fest. Jay Martin is a big fan of my conference that I hold every year. We're holding it in Las Vegas, and we have John Cleese is our keynote speaker, so he should be a lot of fun. And so that's called Turning the Tide. Any other questions? We have just a couple of minutes. July 13th through the 16th in Las Vegas, so it is a hot conference. Yes, David. Oh, on crypto. I do think that Bitcoin and crypto have played a role in why gold has underperformed during this highly inflationary environment. It became an alternative inflation hedge, and I think a lot of people said, well, instead of buying gold, I'm going to buy crypto. And in fact, crypto did better than gold in 2020 during the pandemic and into 2021. But it's lost its luster now, and it's going through the same bear market. Everything's being hit right now. So I think the inflation hedge is off right now. The best one is gold itself, not the mining companies. So that's my attitude there on Bitcoin. Yes. Okay, so how low will the S&P go? Let me tell you a quick story, and then we'll be finished. So I'm a big fan of Jeremy Siegel's book called Stocks for the Long Run. He's a longtime friend. He shows that bear markets never fall 50%, below 50% to 60 or 70, except during the Great Depression. Then it fell 90%. So if you guys believe Harry Dent, which I think he's crazy, but if you believe Harry Dent, he says it's, and even Robert Kiyosaki, they're both saying the greatest stock market crash ever in the history of the world. The only way that can happen is if there's a Great Depression. And is the U.S. government, is the central banks going to stand by and let it happen? Obviously not. They're going to inject liquidity like they've done over and over again, and it's going to recover. Besides, businesses have never been in better shape. They have lots of cash. They've cut costs. So I think this is going to be relatively short term as soon as we get Biden out of the White House, or Kamala Harris, or whoever's running the government, because it's not Biden. Thank you.